As a trader, most likely you've heard of divergence between the price and an indicator, and most likely you spotted a really good divergence trade that if you took it, you would have made, I don't know, thousands of dollars. The problem is most likely if you try to trade divergences, you have lost money in general because they are tricky, misleading, and mostly very subjective to interpret. So if you've been burned by divergence strategies or you want to try them, then stick around. As in this video, I will show you how to really do divergence strategies, and I will show you how I crunch more than 68,000 variations of a divergence strategy to show you the results. And you will be surprised at what I found. First, let's define divergence signals. A divergence signal happens when the price of the instrument you are trading makes a lower low, and an oscillator based on that instrument makes a higher low. So that's a bullish divergence, meaning that the indicator does not agree with the price behavior. Therefore, we expect that this lower low is fake and the price should move up. Same thing on the opposite side. For a bearish divergence, the price of the instrument you are trading will make a higher high, while the oscillator on the same instrument makes a lower high. Again, this disagreement means most likely that the price now will go down because they don't agree with each other. So this higher high is a fake higher high, and we expect the price to go down. Here is the thing. Most YouTubers, gurus, coaches, whatever you want to call them, show you divergences in a chart by hand. So they bring a chart, they draw the lines, and you can easily eyeball a divergence if it's prominent. Like if it's really clear, you're going to see it. But I guarantee you, if we bring 10 traders and give them a single chart and tell them to draw the divergences, no two will draw the same divergence. Every single person will draw different divergences than the other because it's very subjective, and I will show you why. So here is an example of a divergence. This price here makes a low and then makes a lower low here. On the same chart, this oscillator, which is the stochastic, makes a low here, but then makes a higher low. So this is a bullish divergence. The price made a lower low, but the oscillator did not agree with it and made a higher low. So we expect the price to move up, which of course in this case it did. The problem is to quantify this, there are many definitions that has to be correct. So first let's focus on the low. So the low is a pivot. So in this case, this is the lowest bar, and we have multiple bars, higher lows on the right, multiple bars, higher lows on the left. So the first thing we need to decide is how many bars on the left and on the right should be higher lows. So for example, this is a pivot, yes, because we have higher low here, higher low here. This is also a pivot. This is also a pivot. This one, and this one. If we consider one bar to the right, then this is a pivot with one higher low on the right and many higher lows on the left. But if we take two bars, then this is not a pivot. This is a pivot. So to objectively build a strategy around divergences, we need to start these definitions. And number one is the pivot strength. We need to decide how many bars on the left and how many bars on the right to construct this pivot. Number two, we need to decide on the indicator. So this is the same stochastic. This is 14 look back and this is 3 look back. And now you can see I have more pivots. This will totally change my equation because now this pivot, the high one, does not align with this one. You see there is a 1 bar difference between them. Also now I have this extreme low pivot here, this extreme low pivot here. Also now this pivot, which had only 2 bars to the left lower than this high, but now this pivot has many bars lower, that is lower highs. So the oscillator parameters will decide how many pivots and how strong the pivots I will get. So far that's two, the strength of the pivot and the oscillator parameters. Number three is the number of bars between the price pivot and the oscillator pivot. So for example, the price low pivot here is aligned with the oscillator low pivot here. They happen on the same bar. But the high pivot of the price here is not aligned with the high pivot of the oscillator. So there is a 1 bar difference between them. Also, the low pivot here is not aligned with this one. There is also a 1 bar difference. So we need to decide on how many bars overlap between these two pivots. So if it's aligned, great, they happen on the same bar. But if they are within 1 bar, 2 bars, 3 bars, we need to decide on this window of number of bars. We also need to decide on the look back period. So for example, these 3 pivots happen within 20 bars. But then this pivot and this pivot happen with more than 20 bars. And they have this one in the middle, which is not as prominent. So the look back period also has to be decided. And finally, within this look back period, I can decide on which pivot to compare to. So let's say I pick 60 bars to look back. So I have from here all the way here. So which pivot should I compare? This one to the second one or this one to the third one? So you can see how complicated this can get, but that's the only way that you can go about testing divergences. You have to decide on all these variables. So here is an example of the divergences. I have an instrument here. This is the British pound futures on H4. So each bar is 4 hours. And I have here the stochastic. And these histogram bars tell me when a divergence happened. So for example, here, it shows me the divergences happened on this bar. Same thing here, same thing here. But it's really important to know that I only knew about this divergence at this bar. So this is what the second indicator is showing you. Of course, when you eyeball it on the chart, you're going to find this one. But in reality, it's only on this bar that we know a divergence happened. Now, why? Even though I can tell you that the strength of the right pivot here is 1, the oscillator made a low pivot on this bar, and we only found out here. So that's why here we have the confirmation that we have a divergence, a bullish divergence, although the drawing is here. So same thing for this divergence, we know here, and for this bearish divergence, although it happened here, but we only knew at this bar. And here you can see the number of variables needed to define divergences. Now I fixed the stochastic because otherwise we will have 3 more variables here. And of course, every oscillator will come with their own parameters like MACD, RSI. Any oscillator you pick, they have their own parameters. But to simplify the divergence a little bit, I made the oscillator fixed. So you can see here, the low point is calculated using the low, and the high point is calculated using the high, because that's also a variable that you can change, although I fixed it here, but I just wanted to show you. So you can calculate based on the average of the high and the low, or on the close, or on the open, or on the typical price, anything you can pick. So here we can see we have the left strength and the right strength, and the pivot peaks overlap bars. So this is the overlap between the peak of the price and the peak of the oscillator, and then the minimum number of bars between pivots. So 5 means I need a minimum of 5 bars between each 2 pivots. And then the look back is 25 bars. That means I can look back over the past 25 bars to find a pivot. And then the comparison is the second pivot. Now, why I'm showing you all this? Because I want you to know how hard it is to build divergence strategies. Because even with fixing the oscillator and with fixing the low and high pivot, we still have 6 parameters to optimize to find strategies. Now, I also put the strategy on the British pound for hours to find more signals, because if you do this on daily, you will not find many signals. So I run an exhaustive optimization, which is 68,000 plus variations on the British pound futures 4 hours bar. And as you can see, I optimize the left strength, the right strength of the pivot, then the overlap between the price and oscillator pivots, and then the minimum bar between each two pivots, and then the look back period, and then the comparison to what other pivot in the same period. And then I have an exit number of bars. So once I find the divergence, I will enter. So bullish divergence, I will enter long, and I will exit with a fixed number of bars. Again, I optimize that. And 1 is long, 2 is short. So if we filter these optimization results, so let's do first total trades. So I will require minimum, let's say 85 trades, and less than, let's say 450 trades, because I don't want like 1,000 trades that's making on average $2. Also, let's make a net profit. Let's put maybe 25,000. Okay, so we get 84 strategies. So out of 68,000 variations, we are down to only 84 strategies. And if we sort by return to drawdown, we have 4 return to drawdown. So the strategy making $29,000 with $7,000 drawdown, 308 trades making on average $94. So let me bring this here. So if we scroll down, we can see that the best average trade is 113. So I will pick also, it's more net profit, but it's lower custom fitness. Remember, I can still add a filter to the strategy. So this is the best average trade just for comparison. And they're all short strategies. In fact, if you look at this, all of them are short strategies. And this is not a shock. If you watch my Algo versus Crab series, you know in one of the videos I show you how the British pound works really well with short strategies. But it's also good to find another way to find out that British pound works well with short strategies. But here is the kicker. Out of 68,000 variations, without optimizing the low-high pivot, without optimizing the oscillator. So this is like half the parameters. And out of 68,000, we barely found around 80 strategies. And so that tells me it's really overfit. Like we are definitely overfitting to the British pound. Although the British pound works really well with short strategies, but all these figures are overfit for sure. If I run a robustness test, I think all of them will fail. So here is something I wanted to do to compare the results. So on the left here, we have the best divergence strategies, one of the best. And here I have on the right, so it's the same British pound for hours, but now I have a simple RSI strategy. So this RSI strategy will short when the RSI 4 go above 90. And I think we have here. So when the RSI is above 90, we go short, and we exit when it's below 10. So a very simple RSI strategy. There are no filters in this strategy. This is just to compare. So here are the two strategies side by side. On the right is the RSI simple strategy. On the left, one of the best divergence strategies, both on the same instrument, same time frame. And this is making $30,000. This is making $40,000. 2.4 return to drawdown, 3.4. 51% profitable, 61% profitable. Of course, both of them on the short side. Here are the trades, 272. This is 190. The average trade here is 216. Here is 113. There are 8 losing years here since 2006. And also there are 8 losing years here since 2006. They don't happen at the same time, all of them. So let's say half overlap, half not. The point is the RSI has 2 levels to optimize, which is where to buy, where to sell, and one variable, which is the look-back period. And the divergence strategy, even with fixing the oscillator and fixing the low and high, we have 7 variables to optimize. So 3 variables here, 7 variables here, with fixing the oscillator and the pivot calculation of the low and high. So at the end of the day, with all these complications and optimizations, and I can easily get a similar or better results with a simple RSI strategy. Now also, let me give you this bit of information. Throughout the years, I talk to many professional traders, and I have colleagues, and I actually talk to people who work in hedge funds as programmers and as traders. And none of them, 0, do divergences. Now, this says a lot because these people, they have a lot of resources at their disposal. Capital, computer power, programmers, and a lot of smart people. And if those people don't use divergences, then, we should not. Especially since you can achieve the same or better results with other simple strategies. So don't fall in the trap of more complications or looks good on the chart. You have to really backtest and get your opinion objectively based on data. And that's what I try to do in this channel. If you enjoyed this brutally honest take and want more truths that nobody else dare to show you, then subscribe to my Algo Trader free newsletter using the link down below. Every week, I dive deeper into data-driven insights that's going to save you time and money. If you like this video, then you will love the next one.